Bitcoin Treasury seminar online. So here in the last session we discussed about Bitcoin as the apex asset, and I think I covered some slides, but after that I unfortunately lost my connection, and um, the other part uh, was left to cover. So today what I will do is just like run through these slides once again, so that you refresh what was happened in the last session, and then like today we will going into a next space after this session to have casual chat. So make sure, I think most of you have your X accounts. This is just a kind of a experiment kind of a thing. So no worries if you don't have, or like give us your feedback. What do you think about this new thing which we are trying to do? So yeah, um, so here, as you can see here, total global asset value is around 1,000 trillion in the world, and this is how the current wealth pools look like. So real estate and bonds take much of it. Equities is also there at 135. Gold is sitting at 22 trillion, arts at 27 trillion, and money at 129 trillion. And Bitcoin is around 2.5 trillion. So yeah, we have much more room to go into. Also, one thing I think we should focus on is like half of this value is utility. Like even if Bitcoin doesn't exist, half of the value will still remain in these assets. But because of fiat inflation, the other half is is like forced into this, what we can say, into the other pools of capitals like equities, real estate, bonds, money. So other half is forced. It's not, what do we say, it's not natural. So for example, you me and Amol were chatting about the last session. Amol said that I mean most of us would like to have a single home, or a first home, and the homes or houses or anything which we purchase after that, that is most probably an investment, but in some cases that might not also. So most of the real estate as of now is basically more like half part is as an investment. So to give some prime examples, in Lugano, there's a lake called Lugano Lake. So, facing to that lake, almost all the properties belong are as like second homes, or properties and an investment. So mostly these homes are empty, like no one is utilizing it. So uh, this is this is what happens with fiat uh, when the world exists in fiat. But if there's a Bitcoin standard, then most probably um, the house will be owned by the person who lives, and not by a person who just invests um, as a way to store his value, and to keep his money safe from debasement. So the next, the thing that we discussed is the lifespan of an asset. So whatever you do with your money here, you want to store your wealth somewhere. So storing your wealth requires that money to be invested. Last time I gave this example of Saifuddin Amus, that currently, if you are a well-off individual, you have two jobs. First is 9 to 5, and the second is to invest the money earned from that 9 to 5. So when you are investing, you look at this asset lifespan. Like this is basically this gives you the half life. Like um, Basically, asset lifespan L equals to V by M. L is useful life of that asset. V is the asset value and M is annual maintenance. So in annual maintenance, fees, taxes, dilution, upkeep costs, all these things come. So by calculating this, we get useful life, and most probably this is half life. So for example, different assets have different kind of half life. So for example, gold inflates around 2% per year. So half life of gold is around 35 years. Half life of real estate is depending on the location and some other things. Um, yeah. So this is how value decays over time. In the year 10, you have 85% left. In year 20, 65. Year 30, 40%. So financial assets leak economic energy. This is true for most of the financial assets out there, like bonds, equities, and anything which you can imagine. So, mutual funds. How does this financial assets leak energy? Is, for example, current inflation is maybe CPI is 6%, monetary is around 10, 11, 12%. So unless and until you are able to generate more than 12%, your value is decaying over the time and over the period. So your goal will be like to gain more than 12%, just to stay where you are and not kind of an investment kind of a perspective. So just to be where you are today, you are investing in various assets and try to generate more than 12% returns. This is in case of US, and in India, I consider around 15-16%. Basically, if you consider the scenario, bonds, FDs, all this go out. Like if you invest in these, there is no way out that you are beating um, real inflation. Also, on top of that, we have these frictions like tariffs, transfer, fees, taxes, litigation, obsolescence, and politics. So these frictions decay your assets value at a much higher rate. So, for example, you are transferring a real estate from let's say one person to other person, you pay around 8% stamp duty or 8% taxes in Maharashtra. I know about Maharashtra. I don't know about other states. So this is what you pay. And when you are trading equities, you have these taxes, LTCG, and etc. Also, you have STT. So these kind of taxes, fees, GST, all these things decay your assets value over time. Also, if everything goes well, then you have litigations. Maybe someone put some litigation or something on you, and you have to cover that litigation's costs. If all these things goes well, then there are politicians to steal. So, I mean, then you have to be in good books of your politician of your area. So yeah, I was watching an interview of some guy who said, like, if you want to live a free or a life wherein no one disturbs you, and then have good connections with your area's MLA. And if you have good connections with him, he can go um, to an extent to like have your life peaceful, but you have to give something to make connections to your MLA. Now, physical assets better but still leaky. So physical assets are much better than financial assets, but still they have the upkeep costs, insurance, then jurisdiction risks are also there. Storage costs for gold and silver. Also, you have insurance. Then authentication, like how do you authenticate this is 24 karat gold? So there are limits to physical assets as well. Also, one thing in physical assets that they are not easily divisible. So this I explained last time, like physical assets comparison. Cars and ads maintenance cost is like very high. Storage is also a good part. Then liquidity is less. Divisibility is no, not possible for this. Mobility 30 and lifespan is around 25. So this is a chart. This is not in years, but this is a percentage base chart. So this is a comparable value between all these things which I am showing here, like real estate, cars, and gold and silver. This is a relative metric and not an absolute metric. So if you see, gold and silver have a much better lifespan than other like real estate and cars. Maybe in some cases, real estate can have a much better lifespan depending on area and location. So gold, the least bad commodities, but it's still bad. Like it has 2% inflation every year. It has dilution. The half life which I was talking about is 35-year half life. Friction points are again authentication, transport. Like how do you transport the gold? Gold. I mean, our RBI transported around 200 tons of gold last year, but this might have taken a huge amount of costs to transfer from UK to India, UK to back to India. Also, then security costs are there, distribution, poor velocity, like it's not highly the transfer or the transport takes a lot of time. Then divisibility is also very poor for gold. Structural risks, so counterparty risk, confiscation risk. So counterparty, as in even we have brought back around 200 tons of gold from UK, but still I think we have around 600 tons still lying in London. So there we are taking this counterparty risk. Let's say if something relations have go bad with UK, then our gold is at risk. So this is what we call as counterparty risk. Then confiscation risk is basically, let's say RBI brought back gold in our country and storing, or like this might be stolen, or from an individual perspective. For example, if government freezes your locker or something, then your gold can be confiscated from you. Then structural risk, there is no application layer to gold. When you compare it with Bitcoin, Bitcoin has its applications like Lightning Network and all, RGB assets. So when you compare these properties of gold with Bitcoin, then structurally, uh, Bitcoin is much better. Does anybody want to speak?
Yeah, I wanted to speak, but I was not speaking. The thing that I wanted to check with you was like, there's a lot of murmur lately with the gold price rise that gold is a dead asset.
Joe,
Like
you
we
get
lost.
started in about 10, 15 minutes or so.
Oh,
In
someone
that
else is.
time, do be reading over these first two links from the reading
DJ,
today.
I think I might have to
DJ,
mute you. Uh, Server mute. All
yeah.
right, so I've muted him. Yeah, so broadly, my question was like, there's been this murmur that gold is a dead asset. You invest in that capital, and that capital cannot be used for creation of new things. Uh, uh, and that's kind of the similar argument that's made against Bitcoin, that Bitcoin takes the money away from capital markets to just using it to store and preserve wealth. What is your take on that? Like, Bitcoin still is definitely better than gold. Like, it can be used in some productive work. Uh, but and there's also something on this point that this similar guy mentioned lately, that storing your wealth in Bitcoin is better than storing your wealth in artificial cash flow generating instruments, because you got something better. But what's your like whole take on this dilemma that people have with gold or Bitcoin versus the current current cash generating uh, businesses or cash generating stuff.
I think uh, to have an optionality is always better. So Bitcoin gives me an optionality whether to invest or whether to just keep it in self custody. So this thing I think we discussed. I discussed this thing with Bhavik last Saturday on the podcast on Bitcoin Hub, wherein Joe Burnett has made the statement like currently we are being forced to own cash flowing assets for just to store our value. But the problem with the cash flowing assets is most probably a normal individual doesn't get like what he is investing it into. For example, 60% or 70% Americans invest in um, S&P 500, Nasdaq 100, but hardly people might be knowing what is the real business or what's happening in those 100 or 500 companies. So this way we are being forced just to store our value, which should not be the case. So Bitcoin gives us optionality. Like for example, it's optional for anyone to invest in a Bitcoin treasury company. If you ask Alok, he will be okay to like keep his 100% of of his wealth in Bitcoin and not dabble into Bitcoin treasuries.
The point is like the utility of each of these instruments. Utilities to his
Bala, your
Bitcoin
voice is
and
not clear.
Yeah.
the functionality utility is to like kind of match
I think Bala, it's the internet. Is the
Still
internet
like,
stretching your voice?
okay.
yeah. So that was my point. Like, it gives us optionality, and optionality is what we value, and this is how it should be, and not the other way around. Like currently, we are being forced into investing in cash flowing assets. So it gives me an option whether to take out my self-custody Bitcoin and do some business, or like most probably a person with high risk appetite. Most probably, what he will do is like if he has some idea to generate more, or or he thinks that my idea will be able to scale more than Bitcoin or give more returns than Bitcoin in the longer term, then maybe I am open to investing in that idea. But this is optional, this is not compulsory, which is not true in the case of today's scenario. And that's what I think about this.
So do you foresee or do you have any views on how does the gold accumulation and Bitcoin accumulation is going to pan out? As in my broad interest area is how does it affect other people's habit of spending money and then the whole economy being built around people spending money, celebrating, these festivals to spend more money, like this mass media consumption. How do you see that changing, or do you not have any view on that?
So this is very good question. Like uh, as a Bitcoiner, you will see this change in you. Like whenever you are looking to buy something or purchase something, you will think a lot, like a lot, because you know what you are leaving on the table. So obviously this will drive consumption much lesser than current fiat economy, because like why do we, or let's take an example of my generation of the Gen Zs out there. So with Gen Zs, this is a thing which I know. I don't know what do you guys think about this, but the people or the Gen Zs who live in Mumbai, Pune, or basically big cities, everyone has an iPhone, but no one has a job, or even if they have a job, they are earning around maybe 50K, 60K, 70K per month, but they have an iPhone of 1.5 lakhs. So I think this is wrong. Like this is not the way to. I mean, it depends, but in 90% cases, that iPhone is not worth. So let's say if you are a vlogger or if you are a something a content creator, then buying an iPhone might make sense. But for 90% of the Gen Zs out there, I think iPhone won't make sense. So this will obviously drive away the unnecessary consumption which happens in the economy. So I don't know where this GDP and all will go into a Bitcoin standard, but on a Bitcoin standard, you have to make that product really worth for your customer to buy, and not just something shit so that people will buy it. So on the products on a Bitcoin standard will have much better quality.
Yeah, and also this necessity of constantly growing and constantly expanding
Yeah.
is something very peculiar to fiat, pure
Yeah.
fiat.
Hmm. Good answer. This is true. So we have GDP like high growth GDP numbers because we have inflation. Let's say we don't have inflation, then even if we are able to sustain where we are, that would be good.
I think there's a quote that I've seen in tech. People say that the future is already here. It's just not evenly distributed. And thereby, the meaning is like when someone discovers something and creates a small local impact, it takes years and centuries for it to travel to every place in the world and change the whole nature of being, like cultural nature of being, and other ways of being. But just from that small sample, you can gauge as to how the world is going to shape up in future from that small sample. Because if you extrapolated that, this thing will expand, there will be other people who will get hold of Bitcoin, and then their behavior will mimic what is the behavior for existing people who hold Bitcoin. You can extrapolate as to what could happen. I mean, I'm just sharing that, rewording what you just shared, that probably people will not spend as much as they are spending.
Yeah, absolutely.
Saurabh, can I take a dig at your question, the one that you asked? Like,
Yeah,
I
sure.
guess
I just want to get views of everyone.
we went on. I mean, I think your question was around, how do you see utility value of gold? The proportion in terms of breakdown of utility value and monetary value in gold as against Bitcoin, right? So my view is, if you look at gold, about half of gold actually sits as jewelry. Uh, and that seems to be the biggest use case outside of investment or store of value, or money, right? Or savings, outside of all of the monetary use cases.
Yeah, even jewelry, like it comes out like 2 days a year. Rest of the days it's in the locker.
Yeah, yeah. I mean, for whatever reasons, yeah, display days, right? They are they're worth it. They only need to come out 2 days a year because you know people remember it for time, right? And things like that. So most of the usage to me of gold, apart from the monetary use, seems to be on jewelry. The industrial uses of gold exist, but I think if you see, silver is a far superior industrial metal than gold. So there, I don't think there is a lot of industrial use to gold. So most of gold's value, in my view, is its monetary value, and jewelry, again, part of the reason why it's bigger. So much is stuck in jewelry. Again, maybe it's hard to define, right? What part of that jewelry is monetary value and what part of that jewelry is aesthetic value. But a large chunk is basically just these two. Relative to that, Bitcoin, I feel, is has a much better utility proportion. I would say should have a much better utility proportion because it's a payment network. It's backed by whatever, right? Terahashes of computing, and so on. So my broad sense, and I think there is still a lot that can be done, right? with Bitcoin itself. Ordinals happened, which in some way was probably the closest form of jewelry, and then that people felt the monetary value is so much better that this is not something we should entertain, right? And it's also true, when monetary value of something outstrips the other values, people will just use it for that value, right? Uh, so to me, it feels like, yeah, Bitcoin has, I mean, and there's so much to be uncovered. I think in Bitcoin, it's just only been 15 years. People have, people are thinking about writing history on Bitcoin. People are thinking about all kinds of things, right? So there is a lot more utility, I would see. And a part of this monetary value also comes from the utility. I think it's not entirely exclusive of each other.
Yeah, I mean, from that example, right? You mentioned the silver has a lot more utility. So just the transaction piece is not the driver. I would say the utility piece is not the main driver. The main driver has to be like how decentralized and how finite this is. And then of course, like it has to have an utility, which is transferring Bitcoin from one node to another or one address to another address. Uh,
Yeah. So
that's the
if you
utility.
see Lynn's views, right, Lynn Alden, what she tries to say is, at some point, the utility value of using it as money outstrips all other purposes of it, and people will no longer find any value in using it as anything else other than money.
Yeah,
Basically, there is a lot of utility in being good money, right? It reduces transaction
yeah,
fees, it adds
absolutely.
liquidity, and if you can self custody your good money, then it takes away storage costs. There's a ton of utility in just, I mean, money is one leg of every transaction, right? If so,
Yeah,
it's
this
not a small aspect,
yeah, it's a
and
nice
one little
perspective, Sinai.
efficiency in that is worth a lot of value to the whole world.
Yeah, from like nice perspective, from this, like we can gold, even though monetary utility, monetary value of it is paramount. It doesn't mean that any other use of gold doesn't exist. So if we extrapolate that to Bitcoin, we can like sort of make sense of what's happening around the top return issue and stuff.
Yeah, basically the core versus knots is basically happening because of that only. Like knots guys want Bitcoin as money. Basically, I also lean into that thought. But yeah,
It's exactly how ordinals played out also, right? As in, I mean, I always draw analogy from gold to Bitcoin in almost everything I do. And ordinals, what happened was, it drew up transaction costs and stuff like that. I don't know the exact details. I wasn't following that story that closely back then. I also did not have a great understanding of things then. Even now, I think, when it comes down to the deep down network and stuff, I probably don't understand it as well as you. Some of you who are developers or have spent time. But the way I thought about it was, gold has, when you're trying to turn ordinals, in some way look like jewelry to me. And yes, making jewelry has making charges, additional cost, takes away the liquidity and all that, right? But it's hard to not let it exist, right? It's free, permissionless space. uh, People would still do it. You can penalize someone for doing it, for not using it in the way most people agree, but blocking it is another aspect, right? But yeah, now I mean, yeah, it's the lines I was thinking in back then.
hmm.
Knots versus this thing, I'm catching up on that as well. I don't have concrete views on it yet. I'm still forming my opinions. Maybe
Yeah, yeah,
someday.
yeah. Okay. So let's get back. Um, so yeah, for gold, the half life is around 35 years. So what does that mean is like you will lose almost half of your wealth, half of your purchasing power, if you store in gold in 35 years. So this is what it means. So our goal here is basically to find an asset which increases the half life, or which increases the store of the time for which we store our value in it. So this is a brief comparison in with gold, real estate, indexes, bonds, and Bitcoin. So Bitcoin is hard kept as compared to gold. I mean, gold supply inflates by nearly 2% per year. Um, Bitcoin is global and instant. It is also highly divisible. It has like 100 million sats per coin. It can be self-custodied and theoretically unlimited lifespan, because the cost to store Bitcoin is like um, in order of magnitude less as compared to gold. And the one reason why I think gold failed as a money, because uh, custodying gold was the hardest part. Like this is what Michael Taylor says. Like custody, even nations couldn't figure out how to custody gold, and that's the reason why they were dependent on other nations to have their gold. So most probably this was the thing which gold really lacked in it, because even nations, like, forget about people and all, but nations also found a hard time to have custody in gold. And that so this is the reason why basically gold failed as money. And one more thing which I think why gold failed is because of the verifiability factor. So verifying gold was pretty hard. Like it was too hard to verify gold. So
I am I
if you, yeah,
I kind of agree on that. I think custody was its thing, right? But that is something that was going to be an issue for any good money, because people are always going to come to steal it, right? And
yeah,
that's what led to banking of 1600s and all the middlemen. I mean,
yeah, yeah,
banking, the middlemen came in as merchants typically, right? Goldsmiths and Chinese merchants. They came to
yeah.
solve that problem primarily, and that's what led to fractional banking and so on. So gold in some way, yeah, failed or became a part of the system mainly because of its custody risk, essentially because it was physical, right? and
Hmm.
and fact that Bitcoin is not physical is what's going to save it, by not getting captured by others. uh,
Also, this thing I have
and
not
also make it
discussed.
confiscation proof, right?
Hmm.
From the states, but people
So
had to
I just have one. Sorry to interrupt, but so on this topic, right, Vinay, I just have one question. No? Uh, so gold was captured in large amounts by, let's say, institutions and banks, etc. And what they did was issue, paper gold or paper notes on top of it, right? That's how the individual could not save his own gold, and obviously the confiscation, etc. So when it comes to Bitcoin and what we see with ETFs and corporates, buying tons of Bitcoin, how do you see for a regular, not for us Bitcoiners right now, but let's say 20 years from now, there would be a scenario where most of the Bitcoin would already be accumulated by the big players, BlackRock and whatever, and what will be issued will be on top of that paper Bitcoin or something on,
IOUs.
not the regular, yeah, real Bitcoin, right? So how do you, I mean, will it really work that way when, because that was the problem with gold? Would that also happen with Bitcoin? Is my question right now.
I think what Finning talked about it, this thing earlier, like merchants came into gold because without them it would not have worked. But with Bitcoin, it's optional. Like I agree to the fact that Bitcoin ETFs and Bitcoin Treasury companies are coming, and most probably they will have a good amount of stack. But this is optional. Like you can choose to buy a Bitcoin ETF or buy a self-custodied Bitcoin. It's not.
Right now it is optional, I understand, but
No, I
what
get
I'm
your
asking
question.
is in 25 years there would be no float,
No,
right?
no, I get your question, and it's a
I
nice
don't
question
get.
too.
Yeah.
Because do these risks exist with Bitcoin as well, right? Or how is this going to pan out, do you think? Uh,
Just a thought experiment,
no,
let's say.
it's fine. It's great because see, people who are already custodying Bitcoin, I think know this problem or see this problem coming,
Yes.
right? And us Bitcoiners, like you said, we are aware of it. We'll probably yeah, we'll continue to be aware of it. Our conviction will only grow stronger, right, as this grows. Uh, Ones who are now entering through new vehicles like ETFs, these are people who are choosing not to custody it. Many of them are probably in it because it's appreciating in value, it's good portfolio diversificant, and so on, right? Different motives. Don't see this problem as much as us. But I think over time, as Bitcoin grows in value, and this becomes a higher chunk of their portfolio, and right now a lot of people enter because they don't want to miss out, and a lot of people are entering because their investment advisors are adding allocations to their portfolio and so on, right? But as this grows in value, as this grows in popularity, people will find out more about it. People will get to know that real value lies in self custodying it. People will become aware of confiscation risk from states and so on, right? And I think over 25 years, we will be a lot more aware. And at any given point in time, people will have a choice, right? In between, you might even have some countries jump this gun earlier, right? You might see a case in Nigeria where a confiscation happens, and everybody in US will wake up and make a move to move to self custody. You also now see BlackRock saying we will offer you pay in kind redemptions, or we're looking to file for it, or they filed for it and waiting on approval, I think. Why do you think these things are coming in? These things are coming in because they think, okay, if we don't let people do this, people will not buy our ETFs if we don't allow them an in-kind redemptions. Now, in principle, how will it eventually happen when it comes? I don't quite know, but these provisions are coming in because I think people are asking these questions, right? What happens, if there is a ban? You are a listed company. US will say, don't let people redeem their bitcoins. Will you just stop my trade? Will a trade execute when I want to cash out of this bitcoin in these scenarios? I think that's where these mechanisms are coming in, and these people will, because of the nature of the technology, I think institutions can't play the same game, right? Because I think an individual has the ability to custody it.
Right,
Yeah.
right, right. I agree, and I think okay, just to conclude. So I think there are some exchanges also in India, right? For example, CoinDCX does not allow self custody like GetBit does. So
Yeah, I
I don't
think
know.
like
There
if you
are
see after WazirX and stuff, now nobody is even thinking of buying on an exchange like that, right? People are like now saying, okay, now a lot of people are saying, I want to buy Bitcoin, like I want to self custody it, right? And what's the way to do it? This is not the same kind of questions people asked in the last cycle.
right, right, right. Yeah, there is progress for sure. Yes, but okay. Yeah, thanks for the
Yeah,
answer.
good answer. Good answer. Okay, to go back, what I was trying to compare here is like if you see all other properties with Bitcoin, Bitcoin just lacks with proven lifespan. Like when you compare it with indexes, real estate, or gold, currently the proven lifespan is basically 15 or 15, 16 odd years, like basically history of Bitcoin. But the other properties like supply certainty, mobility, divisibility, and custody security, all these properties are way better than the other three assets out there. So that's the reason why Bitcoin, storing Bitcoin, and it's basically an apex asset. Then there are some defects in real estate. I think this is where I left in the last session. So the defects are it has a finite life, it is destructible. So, for example, a natural calamity like earthquake or floods damage the value of real estate. There's maintenance on top of it. There is insurance. There is tax. So all these things basically decay your value from basically your real estate. Then utility constraints, coarse rental, hard to transform, hard to upgrade, limited subdivisibility. So this thing I will discuss in the next slide. Then mobility issues, as you all know, real estate is immobile. It is related to us, like it is situated in a jurisdiction. Then the cost of changing hands of a real estate is high, like 8% in Maharashtra. Risk factors, visibility slash targeting. For example, if yeah. So in the next slide, I will discuss this in detail. Visibility slash targeting, confiscation risk, funding constraints, and elastic supply. So visibility slash targeting is like, for example, a tower in a posh area of of Mumbai, and you don't want that tower to be visible for your enemies, then it's not the case. Like, it's there, so it is there for everyone out there. But with Bitcoin, it is pseudonymous. Like, um, it's verifiable, but it's not visible to anyone and everyone out there. So,
I think
like, in the okay,
just I'm tab there. That's a bit.
yeah.
I mean, because I wanted to. I find it very similar to wearing your gold in large
Hmm.
quantities or in whatever quantity, or
Yeah.
wearing your Bitcoin T-shirt.
Yeah. Good. I mean, this is good comparison with like this
Yeah,
tells
with a
thought.
Bitcoin T-shirt, what's all right is at least you're not giving away the quantity. But
Hmm.
then I don't know, that could be good or bad, right? People are free to perceive what that quantity is, and when you let people decide it, it probably goes the wrong way.
Yeah.
Uh,
Even talking about Bitcoin is like a thing that we show like we have Bitcoin,
yeah,
but
to
There are a
it
lot of crypto
also,
people
yeah.
getting kidnapped and all.
yeah. In France, such thing happened. Like, some exchange founder got kidnapped. Agree to that point. So, but there's a thought experiment in Treasury of Michael Saylor. So, all these slides are made with the help of some chapters in the book called Treasury of Michael Saylor by Anil Patel. So, don't go by the name. The name says Treasury of Michael Saylor, but 95% of the part speaks about Bitcoin and not about what Michael Saylor is doing, like financial engineering and all. It's a good read. So he did this thought experiment of perfect property. So let's say you have a warehouse. What are the properties that you would like to have? You would like to have it as immortal. You would like to have it as indestructible. You would most probably like to have it tax free. You would like to have it teleportable. You would like to have it private. You would like to have it like infinitely subdivisible. For example, this example is very good. Like, it's very good stated in the book. Like, for example, your warehouse is getting $100,000 in Texas, but that same warehouse per square feet is getting around $120,000 rent in California. So, I mean, you would choose some part or most part, or for example, half of your warehouse is needed in California and half of your warehouse is needed in Texas. So this thing can't be done with real estate, but this thing can be done with Bitcoin. For example, I mean, it's optional, but for example, there's an institution which have a large amount of Bitcoins. Then they can basically uh, give a half of or maybe 10% of their Bitcoin to Coinbase Prime for lending and 10% to other lender. So this is optional, but this can't be done with real estate. So with Bitcoins comes optionality, and with optionality, you always have you can always like give Bitcoin to where it like where it is most safe, where it is most what we can say, or you can run a Bitcoin Lightning node with your Bitcoin. So there are some things which can be done better with these properties which Bitcoin has. Then Bitcoin is digitally upgradable, but real estate is not. For example, you have a building which is hotel right now, but you want to convert it into hospital. So upgrading a hotel into an hospital is a tough task. So renovating and all this will take a lot of time, but in Bitcoin's case, it's digitally upgradable, so that thing is easier compared to real estate. Then real estate is not hard capped. Even new land can be made. So in one of the one of the chapters there, it's mentioned like new lands are made. For example, Mumbai. Mumbai was made up of 7 islands, or if I'm not wrong, but Mumbai was basically islands, and then these islands were connected by British. So this is how Mumbai came into the picture. So basically, when they were like dredging the ocean and creating new lands, inflating the current supply. So this will most probably um, like take away the value of the people who had land on those islands. So this is what happens with land as well. So even Dubai. So Dubai has this Palm Jumeirah, which is built on ocean. So they also built by this dredging method. So they created literally a new land. So uh, this what happens by creation of new land? It dilutes the existing landholders' value, which is not the case with Bitcoin. It's hard capped to 21 million. You converge on Bitcoin's properties like digital, scarce, portable, programmable, and 21 million cap. So all these things bring you to this, and that's why a perfect property is Bitcoin. Then we come to equities. So this is very important. Like we were talking about Bitcoin treasuries in most of our previous sessions. So I think a common individual don't understand this risk, like governance risk, operational risk, strategy risk, competition risk, tech disruption. So all these risks are there when you are investing in equities or when you are investing in a business. So if anything changes or anything bad happens with this, then that equity or that company is going to go down, or it is going to go bankrupt. So the governance risk, latest example, Jetking has been Jetking has been put on hold to raise money from retail or from new investors and put it into Bitcoin. It's your opinion, like it's good or bad. It's personal thing, but this is a governance risk from or regulatory risks which happen from government or a particular regulator. Technological disruption, for example, take an example of Nokia. Nokia uh, like remained with the button phones, but world went into the touchscreen phones like iPhones. So they were disrupted by technology. Then competition, for example, Geo disrupted whole telecom industry. Like they gave out free data packs or free calling packs, and they took a huge percentage of market share. So these are the risks when we consider investing in equities. Also, there are some other kinds of risks like financial, counterparty, banking, political, regulatory, and facility risks. So all these risks are given in the book. Um, so feel free to ask anything about this in the TradFi and Bitcoin channel or in the chat, or we will be here around in the X space after 9 p.m. Then there are also some external and market risk such as employee risk, vendor risk, customer risk, reputational risk, war, currency, tax, weather, customs, legal, tort, patent, and there in the end we have life cycle dilution and equity can go to zero literally. So all these risks are being discussed in detail in the book. Feel free to ask anything about this. What I will do is like I'm looking to finish this thing off in this session so that we go into the next presentation in on next Tuesday. Now come to index funds. So most of the middle class who don't know how to do the risk reward analysis or how to do security analysis and who don't know how to invest in equities, he comes here. like he invested in the index funds. So most of the middle class invests in index funds for storing their value. But index funds also have risks. For example, selection bias or survivorship bias. So if you take an example of S&P 500, let's say we go back 20 years from now, you will hardly find a company which was there in that index 20 years back. Also, there's a selection bias. So in S&P 500 index, they have a committee which takes care of what is included and what is excluded out of that particular index. For example, MicroStrategy was not allowed to be the part of S&P 500 in the last committee review. So this is basically not a passive thing. This is an active thing happening on an index level. So if you are investing in an index fund, you have to take these four assumptions like benevolent indexer, durable success, like US or any country which you are living, that country should most probably succeed or should like success going down or going forward into the future. A country like Pakistan, that index might not work when you are investing. Stable domicile and US dollar hegemony. So you can understand this US dollar hegemony by currency. So for example, you have invested in an index of Argentina, but currency is continuously collapsing, then essentially you have lost value. So these four are the key risks when you invest in index funds. Then hierarchy comes here, like best digital capital is Bitcoin because it's non-sovereign, hard cap, portable, self-custody is very easy. Then conventional capital like prime real estate, broad equity index. Then there's the 60-40 sovereign debt, like equities and debt mix portfolio. Only Bitcoin reliably exceeds cost of capital across long horizons. So when you take into account this 15% global M2 inflation, then it's very hard to figure out which equity, which real estate, which most probably there won't be a bond out there. But Bitcoin easily beats all of this, beats 15% global M2 very easily in long time horizon. Also, there's currently adoption happening of Bitcoin, and that's the reason why we are seeing Bitcoin's CAGR much higher. Then now, just focusing in the last part, for example, you run a business or you run a company, uh, or you can take your personal example as well. So you face this treasury problem, like you have this toxic capital which is leaking out in value, basically cash. So let's say you are a listed company who has $100 million in cash. So that cash is losing or leaking out 6 to 7% of its value every year. So if you leak 7% every year, you are basically left like half of your value has been eroded. So what things you have done with 100 million 7 years back, now half of it can be done today. So why this is happening, like ineffective solutions, negative working capital tactics, then buybacks and dividends. So to avoid this 7 to 10% decay per year, companies have figured out some ways, like they work on negative working capital. So there's a company, Hindustan Unilever, which when I was investing in equities, I it came to my mind, like their working capital is negative. So for example, but their only working capital is negative, but they still have cash in their balance sheet. Like this doesn't justify the fact that they don't have cash in their balance sheet. So for example, Hindustan Unilever is procuring products from the manufacturer and they are selling to a retailer or DMart or the or to the basically they are selling to some customer. So what does negative working capital means is like they are paying their manufacturer at a later period in time, and they are collecting their payment upfront. For example, if Hindustan Unilever gives their products to DMart, DMart pays upfront, and Hindustan Unilever pays to the manufacturer after 30 days. So there's essentially their working capital is negative 30. So, and also buybacks are happening. So buybacks is like we did a session on buybacks maybe 4 to 5 months before. There's a website called bitbuyback.net or something, which one of our guests who have made. He is on Discord. I think Lala. His ID is Lala. So he made this website where he compared what would the company's stock will look like if they would have bought Bitcoin instead of doing buybacks. So what is buyback? If you're not aware, buyback is like buying back your own stock. So this artificially inflates your value of your stock, and this spreads out positive messages about the management has trust in the business. Then why Bitcoin has the edge? Basically, again, the same story: 21 million hard cap, zero monetary dilution, self custody option. Settlement properties, it's 24/7 global, nearly frictionless, upgradability. It's software basically, it can be upgraded. Then the last slide is basically our goal. What is our goal? Is to increase our lifespan of our assets value. So as you can see, as of now, Bitcoin's effective half-life is around 100 years, and this will continue to increase with every halving. So Bitcoin minimizes M, which is here in the denominator: maintenance, taxes, custody, transport, dilution, and policy risks. All these are minimized if you understand the technology behind Bitcoin. So yeah, this was it. I think, Saurabh, we are going to X, if I'm not wrong.
Hey everyone, yeah, so what we are doing is we are doing the session here and we are experimenting. So this is an experiment. We'll do the sessions here which will be recorded and X will not be recorded, but that's where we will do our chats. So I'll just share the link for X Spaces. We can all join in there and continue our discussion on this lecture, on this session.
Also,